Welcome, Bitcoin fam, to the #1 Bitcoin pod. In today's show, we shall discuss a $10 million Bitcoin supply shock forming inside America's retirement system. That's right, breaking news. White House clears review for proposal to allow crypto and 401k retirement plans tapping into a $13 trillion market. Also, Michael Saylor's strategy dominates DAT Bitcoin buying as treasury demand collapses. Also, Mara sells $1.1 billion in Bitcoin to buy back debt at a 9% discount. We'll also discuss Fidelity's new Bitcoin study challenges the traditional 60-40 portfolio. I'll also be breaking down the latest technical analysis and everything you need to know in the market. All this, plus so much more, right here in today's show. If you're new to the show, important, smash the likes and hit the subscribe for more daily content just like this. I broadcast each and every day. We're the most consistent Bitcoin podcast on the planet. And if you don't know, now you know. Let's kick it off with our feature story of the day. You know, I always bring the heat. We have a $10 million Bitcoin supply shock maybe forming inside George Foreman, that is, inside America's retirement system, and almost nobody is talking about it. So yeah, headline here today, and this is why this sparked this topic. White House clears review for proposal to allow crypto and 401k retirement plans, and I'll dissect this here in a second, but first I want to hit you with what I came up with. When you include all employer-based defined contribution retirement plans, the number rises to 13.9 trillion in capital, which Bitcoin will be able to tap into once this is approved. This is the backbone of the American retirement system. In fact, if any of you have any 401k, let me know in the comments. I don't have any, nor does Nipinator. I'm just saying. But anyways, for decades, that money flowed into the same assets, stocks, bonds, and mutual funds. Bitcoin simply wasn't a part of the equation yet. But something is beginning to change. Large financial institutions are quietly building that infrastructure, which allows retirement accounts to gain that exposure to the BTC. Spot Bitcoin ETFs now exist as of January 11, 2024. And in 2 years, BlackRock, IBIT, the largest, most successful Bitcoin ETF in general, the most successful one of all time, accumulated over 800,000 Bitcoin in 2 years. Let that sink in. And that's one asset manager. You also have major custodians securely storing institutional Bitcoin, such as Coinbase Prime. They're the custodian for strategy via Saylor's company, BlackRock, and many others. And retirement platforms beginning to explore Bitcoin allocations inside the long-term portfolios. And at first, the allocations are small, 1%, 2%, and even Bank of America is saying, recommending 4% now. You know what I mean? That's the start. But even those tiny percentages become enormous when applied to trillions of dollars. Because the moment retirement capital begins allocating to Bitcoin, the demand shock becomes massive. This is exactly why BlackRock CEO Lawrence Fink recently warned that even the small institutional allocations to Bitcoin would send the price to $700,000 per coin. And this is where the real story begins. Bitcoin still operates inside a market that is tiny compared to the capital now circling it. At today's market cap is roughly 1.4 trillion in total market value, which means it's literally half the market cap of Microsoft, which is exceeding 3 trillion. Gold alone, though, sits at 36 trillion. And when gold peaked at the all-time high of like 5,700 an ounce, it surpassed 40 trillion. Global bond markets exceed 145 trillion, and the global real estate market exceeds 390 trillion. And Bitcoin's demonetizing all of these pools of capital. Retirement capital represents another massive ocean of money, and now Bitcoin's appearing on the radar. But demand is only half the equation. This is where things get very interesting. The other half is the supply. As Bitcoin supply behaves very differently than traditional assets. There is no board of directors that can issue more shares. Thank God for that. And there is no central bank that can expand supply during periods of high demand or war. Thank God for that as well. Bitcoin's monetary policy is fixed, permanent, and unchangeable. That's a beautiful thing. The total supply was programmed from Satoshi in the very beginning. 21 million, hard cap, baby, finite. But here's the part many investors misunderstand. The theoretical supply to Bitcoin is not the same thing as the tradable supply, because the amount of Bitcoin that actually circulates through the markets is obviously far smaller than the total that exists. Over the past decade, enormous quantities of Bitcoin migrated to the long-term storage. Early adopters hold large reserves that rarely move. Institutional buyers are building strategic treasuries, which we're witnessing in real time at unprecedented levels, thanks to strategy, right? And Bitcoin ETFs absorb thousands of coins every week. And Saylor just proposed another $42 billion acquisition plan to buy more Bitcoin. So the corporate balance sheets now contain Bitcoin as a reserve asset. There's in fact now over 200 companies following in the Saylor playbook. And every time Bitcoin moves into long-term storage, it effectively disappears from the liquid trading supply. The coins still exist, but they're no longer available to buy, which means something subtle but powerful is happening at the same time inside the Bitty market. The pool of capital interested in buying the Bitcoin keeps expanding. Meanwhile, I still want to talk to Samson, but the amount of Bitcoin actually available to purchase obviously is shrinking. This is how supply shocks form. And when supply shock meets trillions of dollars of incoming capital, markets do not move gradually. They reprice violently. First 200 Gs will double, maybe 250 of the current firmament, then 500 Gs, then a million. That's right. But if retirement capital begins allocating at Bitcoin at this scale, those numbers may simply represent only early milestones, because trillions of dollars cannot enter a fixed supply asset quietly. It forces a complete repricing of the entire network, the kind of repricing which eventually produces numbers that markets once believed were impossible. And that's where these numbers come from. 5 million per coin, 10 million per coin. We've even heard Saylor predict 21 million per coin or more, not because of the hype. It's simple mathematics, simple supply demand. Bitcoin is gradually moving from niche technology asset into the architecture of the global finance. And the moment retirement capital begins allocating in size, the transition accelerates dramatically, which leads to a question that very few investors are even asking. Because when demand explodes and supply cannot expand, price only has one direction to move. So what happens to Bitcoin's price when trillions of dollars in retirement capital begin competing for an asset whose supply can never increase? That's my question for you today. Let me know in the comments. And here's another example. If just 5% of U.S. retirement capital allocates to Bitcoin, that's roughly $700 billion entering a $1.4 trillion market. And Bitcoin supply can't expand. The math gets interesting fast. You feel me? But there you go, yo. And actually, as a bonus, I want to read this one to you. I posted this last night. Very short post, but very powerful. For over a decade, the high priest Max Kaiser warned about the coming global hash war. Most people thought Bitcoin was just a trade. Now the corporations are hoarding it. ETFs are absorbing supply. Nation states are entering the race. The first Bitcoin superpower hasn't been fully revealed yet. But when it is, the world order changes overnight. And there you go, yo. Which nation do you think that will be? Could it be a China, a Russia? Will it be the U.S. if we actually move forward with the Strategic Bitcoin Reserve Executive Order, which got signed back in March of 2025, but nothing has happened? Let me know. But we all know Bitcoin country got the strategic first movers advantage thanks to President Bukele making Bitcoin a legal tender back in 2021. I refuse to have my asset tied up in an account that I have to pay a penalty for accessing. I'd rather have a Bitcoin stack that I can liquidate when I need it. And this is a great point. We often talk about Bitcoin ETFs and we talk about strategy, the largest corporate player. Self-custody is superior to all that because you're holding the underlying asset versus paper, Bitcoin, you know what I mean? So there's no second best when it comes to that. And it's important we preach this message because only properly self-custodied Bitcoin is unconfiscatable. We cannot say the same regarding ETFs or strategy or any corporate treasury play because the government or lizard folk behind the government can single-handedly, create a Bitcoin seizure act, just like they did in 1933 with gold. Let's dive into our next story of the day. White House clears review for the proposal to allow the 401k retirement plan. That's right. White House Office of Information of the Regulatory Affairs has completed its review of the Department of Labor proposal, which would reshape how 401k fiduciaries evaluate alternative assets, including digital assets. Their website shows the review concluded on March 24th, which was 2 days ago, with the action marked consistent with change and proposed classified as economically significant. They also said they now expect to publish the proposed rule for the standard 60-day public comment period, which is usually followed by revisions and issuing of the final rule. The proposal allows President Trump's August 7, 2025 executive order directing federal agencies to expand access to alternative assets in 401ks, including exposure to digital assets through certain investment vehicles. The order directed to reevaluate restrictions around alternative assets and defined contribution plans, including obviously digital assets like Bitcoin, private equity, and even real estate. It also called for interagency collaborations between the U.S. Department, Treasury, and the SEC. The completed review clears an interagency hurdle for proposal, which would widen the path for alternative assets of the U.S. defined contribution retirement plans. Also, crypto-linked exposures are moving closer to the 401k market. For example, May 28th, they rescinded the 2022 compliance release, urging fiduciaries to be extremely cautious when considering crypto for 401k retirement plans. I'd be very cautious having no exposure to Bitcoin, but that's just me. Signaling a broader shift in the federal government stance towards retirement plan exposure to digital assets. Meanwhile, the U.S. retirement market reached the record $48 trillion. Shit, I didn't even know it was that much. I looked it up on Google and it was only 13 trillion. So it's much bigger pool of capital than I even anticipated. That's good. Excelente. Also, Indiana advances crypto retirement access. Other U.S. states have launched their own legal initiatives to make digital asset a retirement plan asset. For example, that was back Feb 25th. Indiana lawmakers passed a bill which would require certain state retirement and saving plans to offer a self-directed brokerage option with at least one crypto investment option by July 1st. 2027. The bill would allow Indiana citizens to hold Bitcoin and digital assets as part of the retirement plan for the first time. But there you go, yo. I mean, this is just the beginning. Again, pretty significant pool of capital in 401k, and it's one of the smaller pools of capital, but Bitcoin will be demonetizing all asset classes. As a wise man once said, it's all going to zero against the pretty little bitty. Next up, Michael Saylor's strategy dominates DAT Bitcoin buying as treasury demand collapses. Here's some of the highlights. Corporate Bitcoin buying is effectively consolidated around a single firm known as Strategy, formerly known as the MicroStrategy, MSTR. Which acquired about 45,000 Bitcoin of the past month. I think they just recently exceeded, 760,000 biddies, while all other treasury companies together bought only about 1,000 Bitcoin. So Saylor's purchasing effectively 45 times the amount of Bitcoin than all the other treasuries combined. Hence, there's no second best when it comes to Bitcoin treasury company. You got the Michael Saylor, and then there's everyone else. Strategy now holds roughly 76% of all the Bitcoin owned by the treasury companies. Got a monopoly here. It's like owning Boardwalk and Park Place, with the hotels and all that shit. Creating a concentration risk of the trade once pitched as broadening institutional ownership of the asset. Quite hilarious, but clearly becoming the largest Bitcoin bank, which is his ultimate ambition. Now, the downturn for the Bitcoin price above 110, actually we hit the 126 firmament back in October, fourth quarter of last year, and it's been downhill since, yo. We recently bottomed out at like 59.9. Let me know if you guys think the bottom is in. Corporate Bitcoin buying has narrowed to a single company, clearly. Strategy, the largest corporate hodler of the world, purchased roughly 45,000 is no joke. There's massive accumulation. This chart says it all. It shows you the number of Bitcoin purchases made by other treasury companies skyrocketed to 54 in a 30-day period. That was back in August of 2025, in the middle of the Bitcoin treasury summer. That's when everyone was following in the Saylor playbook. But look at now. It's just Saylor doing his thing. Again, purchasing 45 times more than all the other corporate treasury plays compiled together. Every other company combined brought only 1,000 Bitcoin in the same period. That's a 99% decline from a peak of 69,000 Bitcoin in August of last year. Their share of the total purchases collapsed to 2% from 95% at the height of the trade. Saylor Strategy, again, 76%. You already know the scenario has played out exactly as described. Also, July, August 2025, the summer the companies were accumulating. Bitcoin was 110, back then. Strategy moved to insulate itself, disclosing December 1.44 billion cash reserve. And recently, he just announced another $42 billion raise. I believe it was 21 million via MSTR, which is, the stock. And then also one of the other products, which is the high yield STRC stretch, raising another additional 21 billion in capital, being raised via the infinite money glitch known as the Sailor put. And then that's all going to flow into Bitcoin. So, I think Sailor's accumulation is only accelerating. He's still doing billion-dollar buys. No one else is nowhere near what he is doing right now, as far as corporate plays are concerned. But very fascinating. Sailor, already has over 3% of the entire circulating Bitcoin supply. He'll soon have 5% when he hits 1 million, which he's fast approaching. I predict it'll happen probably in the second or third quarter of this year. And he's not going to slow down there. Eventually he'll have 10% of the supply, and the race is on. BlackRock's IBIT, the largest ETF, has roughly 800,000 Bitcoin, similar to Sailor. So we'll see who gets to 1 million first. Let me know who you think will succeed first, cross the finish line, which is really just the start of the race because it's a motherfucking marathon. Next breaking story of the day, Mara sells 1.1 billion in Bitcoin to buy back debt at a 9% discount. Maybe it's some form of a trickery here. Let's break her down. Mara sold more than $1 billion of Bitcoin in March to repurchase convertible debt at a discount, using its Bitcoin holdings to reduce leverage. Interesting. The U.S. SEC filing, the largest listed U.S. Bitcoin miner, said it would buy back $1 billion of zero coupon convertible notes due 2030 and 2031 for roughly 913 million cash, capturing 88 million in savings, close to 9% discount on par. The company said it just sold 15,000 Bitcoin for around 1.1 billion between March 4th and the 25th. Well, that sucks. To fund the transactions, which it said would cut the outstanding convertible debt by 30% to roughly 2.3 billion once the deals close at the end of the month. And according to BitcoinTreasuries.net, Mara now only holds 38,000 Bitcoin on the public balance sheet. Damn, so Sailor's that much more in a pole position because ain't no one remotely close to his holdings. Mara was number 2, and they may still be, but there's some competitors here. Mara's chairman and chief executive order, Fred Thiel, I wonder if there's any relation to Peter, commented in a release that the transaction enhanced the company's financial flexibility and increase the strategic optionality as Mara expands beyond the pure play Bitcoin mining into digital energy and the AI HPC infrastructure. I don't know what the HPC stands for, but it sounds like a fucking STD. Mara's pre-market share price reacted positive to the news, rising from yesterday's close of $8.25 to $9.29, a gain of 12%. So maybe they know what they're doing, but I'm always skeptical when they start offloading their stash. You know what I mean? The move follows a $1.7 billion net loss of the fourth quarter. This may explain what's going on. Driven largely by non-cash fair value adjustment of the Mara Bitcoin holdings, Mara pushed back against speculation that was quietly selling down his Bitcoin holdings. It leads me to believe they're in a precarious financial situation with Bitcoin price kind of being suppressed right now. Miners are kind of at a loss. You know what I mean? So maybe they're forced to do it. I don't see why they would willfully do that if Bitcoin was thriving right now, like at an all-time high. You know what I mean? Mara is part of the broader shift amongst crypto miners seeking more stable revenue streams. Exactly. Redeploying energy and infrastructure towards AI. So maybe they look at the AI being a better, higher, and best use to be more profitable right now. That's my understanding. BitDeer also sold down his Bitcoin treasury to zero. Fuck. In February, and pivots towards infrastructure services, base revenues, and cloud and AI. So it's like a lot is moving into AI workloads right now. Follow the money. Next up, Fidelity's new Bitcoin study challenges the traditional 60-40 portfolio. That's right. Fidelity has used a new research report and shut out Jurrien Timmer. There we go. He's the head of macro over at Fidelity, and he was the first one to predict that I'm aware of, Bitcoin going to $1 billion per coin. He even put a timeline on it by 2038. So Fidelity is the most bullish asset manager to ever exist. That's kind of cool, but I just want to throw that in there. They're arguing Bitcoin's role in portfolios can no longer be dismissed as a fringe question, especially as the assumption behind the classic 60-40 mix come under pressure. The report opens, and you can actually download that report here. Unusually direct framing. They say the central question is no longer whether Bitcoin merits consideration. Fidelity says instead it asks, what's your current Bitcoin allocation and why? For the firm's research team, zero exposure may still be valid, but it now requires a well-informed rationale. What do people say? Peter Schiff told me so. Jimbo Cramer's, Terrence Howard says it's going to die. I can see that in people's responses. That argument rests first on Bitcoin's historical numbers. Fidelity says Bitcoin has been a top-performing asset in 11 of the past 15 years and over multiple time horizons. It's the most appreciated asset in human history. That's a fact. Has posted the highest return as well as the highest risk-adjusted returns among the assets it examined. The report acknowledges the familiar objection, Bitcoin's volatility, which is absolutely an opportunity, remains the highest of the group, but argues that the Sharpe and Sortino ratios compare favorably, while the bonds have looked particularly weak on both nominal and inflation-adjusted terms. You heard? From there, the paper tries to move the discussion away from philosophy into the portfolio construction. Fidelity leans on Bitcoin's hard cap, its low long-term correlation to the major asset classes, and the sensitivity to the monetary expansion. One of the report's stronger macro claims is that it changes in global M2 have explained 87% of the Bitcoin price changes over the past 15 years, and an R-squared basis, for you algebra guys out there, though Fidelity explicitly notes the correlation does not by itself prove causation. It also argues that Bitcoin and gold are similar enough to share the inflation hedge narrative, but guess what's happening right now? There's a great rotation. That's right. Gold just witnessed its biggest market crash in over 50 freaking years. And where do you think that money is flowing? Into the BTC. But distinct enough to remain complementary rather than interchangeable in the diversified portfolios. The most consequential section for allocators in the portfolio work using a traditional 60-40 portfolio of the U.S. stocks and aggregate U.S. bonds on the base case. Fidelity says adding Bitcoin would have historically lifted both annual and total returns. Volatility rose and expected, but the report says the increase was compensated by the stronger risk-adjusted returns, with the biggest improvement in the Sharpe and Sortino ratios showing when the allocations moved from 1 to 3%. And just that small, allocation change moves the needle, exponentially, which is mind-boggling. And perhaps more notably for the conservative managers, Fidelity says the maximum drawdowns did not increase as dramatically as many would assume, partly because of low correlation and partly because annual rebalancing kept the Bitcoin sleeve from dominating the portfolio. Fidelity's modeling does get more aggressive deeper in the paper. Let's talk now. In a mean variance optimization exercise using what it calls conservative Bitcoin assumptions, 25% expected annual return and 50% volatility against 14.5% expected equity returns and 2% for the bonds. The maximum Sharpe portfolio included 9.4% Bitcoin and no bonds at all. If you're to ask me, 100% cold storage, fuck your bonds. Like, who has any interest in bonds? Barry Bonds, maybe, because that's his name. Other than that, and maybe the government, but a separate Kelly criterion exercise produced 65% position size using historical annual returns, though Fidelity immediately warns that this is not an investment recommendation. They got to say that. Protect their tail, ask the Nippinator. And notes that more conservative assumptions bring that figure down to 10%. The point is less that institutions should adopt those weights than the Bitcoin asymmetric payoff. But let's knock out our final story of the day, fam. Bitcoin dips 3% as analysis says 70 G's. Bitcoin price, not obviously bearish. Let's break her down. Here you're looking at a one-day chart. We got some green candles forming like George. Volatility picked up as the U.S. session began, with traders reacting to the latest developments of the U.S.-Iran war. A reported lack of mutual understanding over the peace proposal followed pressure from U.S. President Trumpster. In the Truth Social post, Trump called Iranian negotiators very different and strange. They are better get serious soon before it's too late. Fuck around, find out. Because once that happens, there is no turning back. And it won't be pretty, which is suggesting it's going to be ugly and violent. That's Trump for you. U.S. stocks turned red at the open, while attention also focused on the longer-term impact of the conflict on inflation. And as reported by the Kabisi Letter and others, Organization for the Economic Cooperation of Development put U.S. inflation at 4.2% in 2026. Meanwhile, oil is up like fucking 30-40%. I put $75 in my tank of gas. It went 3/4. I used to be able to fill up the tank for $50. So I don't buy into any official inflation rates, never have. The suits are always lying. I'm sick of it. Potential rate hikes for the US and the EU are now back on the table. That's what's up. Interesting. And with Bitcoin still wedged in a narrow range, trading company QCP stressed its resilience within the overall macro landscape. Yeah, I must say, Bitcoin has been holding strong even on the landscape of what's happening with the war right now. Bitcoin hovering at 70 Gs. Price action still feels more like quiet consolidation than outright stress. Preach! The broader macro backdrop remains fragile, with risk sentiment weighed by renewed Middle East headlines. The oil still carrying a meaningful geopolitical premium, even after pulling back from the week's highs. QCP described Bitcoin's price activity as not obviously bearish. For now, Bitcoin's trading like an asset being accumulated on the dips, but not yet chased. The range is holding. The surface is defensive but orderly, and macro remains firmly in the driver's seat. And checking out the latest overall market perspective on CoinMarketCap, you can see total crypto market cap today down close to 3% at 2.36 trillion, which again is mind-boggling. Microsoft, for example, has like $3+ trillion market cap. So all of crypto right now is smaller than fucking Microsoft. Again, mind-boggling. Bitcoin specifically is 1.373 trillion total market cap. Checking out the Crypto Greed and Fear Index, we're back down at a 10 in extreme fear. And checking out the infamous time chain calendar, today's block height 942,344, and you can exchange one fiat monopoly dollar for 1,454 sats.